Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we've got Arn Cenedella with us from Greenville, North Carolina. So it's great to have you, Arn. It's a little later. It's like 3 hours later for you, but it's fantastic to have you on. You are actually a Bay Area native, so it's going to be an interesting story to tell us how you got from the Bay Area, growing up in the Bay Area, and then off to North Carolina. So I'd love to hear it.
Yeah, so pretty much born and raised in Los Altos, Mountain View. And when I was a little kid, Libby Canned Food Company was actually the biggest employer in Santa Clara County. So old timers understand that Santa Clara Valley was apricot orchards and it was agriculture. And you know, had the good fortune to be on the San Francisco Peninsula when it transformed into Silicon Valley, creating great amount of wealth, changing kind of the human experience with tech and the web. So it was an exciting place to kind of grow up. Like many in America, middle-class American kid, parents said, work hard at school, get some good college education, get a good job. And I kind of followed that, ended up with a master's degree in chemistry from the University of Michigan. Wanted to return to the Bay Area, which I did in 1978. And I happened to go to work for my father, Hal, who had a residential brokerage business in Menlo Park. So I basically spent my entire life in the real estate industry. And again, I just feel thankful. I was a broker and started to invest in probably the best residential market in the world. And right. And back in 1980, you could actually still buy rental properties in the Bay Area that kind of made some sense. No longer true, but back then you actually could.
Yeah, you could buy some. We came out here and well, a little later than that, but how much was your first house you bought?
107.5.
And that sounded probably outrageous at the time.
Well, I closed in 1980, September 1980. I paid 11.75% for my mortgage.
Wow.
And for people who are old enough to remember, by spring of 1981, mortgage rates were at about 16 and 17. And like most people, when you buy your first home, it's maybe smaller. It's maybe not in the greatest neighborhood. My first home was actually in East Palo Alto.
Oh, yeah. Okay.
Right up against Bayshore Freeway, Highway 101. You could throw a rock out my backyard and hit the freeway.
There's no sound walls at that time.
There were no sound walls at that time. By the time I moved, we were there 6 years. And then like a lot of real estate people, you buy your first house, you live there, you start making a little more money, you want to move to a better location. We kept the first house as a rental, and I moved to San Carlos, where basically I lived, raised my family for 28 years. And of course, San Carlos is a great place to raise a family, like most of the Mid-Peninsula is. So, but yes, an interesting historic look at kind of the huge changes that went on in the San Francisco Bay Area over time.
And that first house in San Carlos is probably worth what, $2 or $3 million now?
It's only 1,200 square feet. Back in 2014, I sold it for $1.4 million, about 1,200 a square foot. Nice neighborhood, White Oaks. Sold it to two women who were married, and one of them was executive vice president at Google Motorola.
Wow.
And interestingly enough, they were both 32 years old. which is the same age I was when I bought that house way back in whatever it was, 1986. And I remember meeting them after close, and I came over to the house and we popped some champagne, and I started to cry because when you're in a house in a neighborhood on a street for 28 years, there's a lot of memories. And
yeah.
I was happy to turn the house over to them. They lived there about 7 years and then turned it over to a flipper who kind of did a major remodel. And I think it ended up selling for about $1.8 million, which is probably about what it's worth now. But yes, prices in the Bay Area are high.
They've changed over the time. So
Yes.
then 28 years later, you moved to Greenville?
Yes.
All right. So why Greenville? That's you're empty nested now?
Yes, empty nested, and my life partner Laura, we've been together 21 years. She's never been married, no kids, very independent gal. We're happy, so it all works. And the Bay Area is a great place. If I was a young person anywhere in the world and I wanted to find my fame and fortune, where would you go? You'd go either Silicon Valley, maybe New York, maybe LA. But as you get older, things change. You want a little more relaxed situation. So we kind of got on in the Carolinas and explored it and ended up moving to Greenville, South Carolina. There is a Greenville, North Carolina, but in any case, it's Greenville, South Carolina. And we're basically midway between Charlotte and Atlanta. We're about 90 miles from Charlotte, 120 from Atlanta, right on the I-85 corridor. And as most real estate investors know, when you're on a major interstate corridor, it's usually a good place to invest because the growth is right along the corridor. And if you're kind of between two big metros, eventually the growth is going to meet in the middle. Back about 2000, I started investing in Austin. And if people are familiar with Austin, Texas, it's connected to San Antonio by I-35. It's about a 50-mile difference. When I started investing there, it was basically farm country between the two cities. Now it's wall-to-wall people, and towns like New Brunswick and all that are some of the hottest investment markets in the world. So as an investor, if you can invest along a major interstate, you're probably going to do okay because that's how the growth will follow.
So you started in Austin, but it sounds like you're not in Austin any longer.
No, when we moved to Greenville, I kind of moved all my equity to Greenville. I kind of like to be a hands-on operator. Austin did very well, but I was excited about what I saw in Greenville and, kind of took my profit and moved on.
You exchanged into new multifamily in, well, maybe not new, but other multifamily in
Correct.
Greenville area.
Yes.
So you own about 1,000 units. Is that what you're doing?
Well, I'm general partner on 1,000 units, meaning I'm the decision maker. I wish I owned 1,000 units, but I have a significant share of the property. And as the general partnership works out, I have a share of the profit. So basically, if I perform, find good investments for my investors, they take the lion's share of the profit, but I get a share of it, and that share of the profit could be significant. So I'm general partner on 1,000 units and are responsible for kind of operating all those properties.
So what do you look for when you're trying to find a new property?
Yeah, I'm very much an old school investor, and I think everybody understands real estate is local. Within the Bay Area, you can have a neighborhood You go a mile away, the characteristics of the neighborhood could totally change. So I'm a big believer in local knowledge. And so all my investments are basically now in Greenville County. It's a market I know well. And oftentimes you hear investors on forums kind of ask, well, what's the best market to invest in? Right. Dallas, Fort Worth, Charlotte, Phoenix. And there may be some validity to that, but my answer is the best market to invest in is the market you know best. So you can make money investing in San Francisco if you know that market. You can make money investing in New York if you know that market. So for me, it's very much about market knowledge because that's really where your competitive advantage is. You know the rents. You know what areas are problematic. You know which areas are starting to get hot, where the flippers are moving in and kind of the young hipsters are moving into some areas that maybe aren't traditionally highly thought of. But if you can get in front of that trend and kind of recognize, that's how you really make some good investments. And so we stick to Greenville County. It's a booming market, both in terms of population and job growth. BMW's here, Michelin's here, GE's here. Every X car BMW makes in the world is made in Greenville, Spartanburg. Sounds weird, but it's factually true. And so the economics are pretty good here. Plus, there's a good quality of life.
No, our son-in-law is a professional race car driver, and he ends up in your territory all the time. So
yes.
It's a big race area, big car area, amazing area. So are you looking for value add properties, or are you looking for just a good return type property?
Yeah, that's a good question. And our kind of non-negotiable is a geographic parameter. And within that, we're open to all sorts of product. So we own stuff from 1970s to new build to rent communities.
Oh, wow.
And kind of what happened when we first kind of opened Spark, which was about 5 years ago, we went after existing assets and bought those. And then, as many of your listeners may be familiar, particularly in the commercial market, the multifamily market, the peak of the market was about 2022, maybe Q3, Q2, 2022.
Interest rates were very low.
Interest rates were very low. And it's funny because everybody knew they were historically low, but somehow people forgot historic doesn't mean normal, right? Historic means unusual. And so a lot of people jumped in expecting those rates to continue, and some are suffering now. But what happened when interest rates went up, owners of existing assets still had pricing expectations on that historically low debt. So basically, commercial real estate activity, and I'm a multifamily guy, so I don't know industrial, I don't know office, so my comments are about multifamily. From 2022 to 2023, I think multifamily sales volume dropped 75%. So wow. Basically, the multifamily market hit a dead end because the sellers wanted pricing at 4% debt. The buyers were looking at 6% debt, and the numbers just didn't make. So what we did, we still wanted to acquire property. So we go, okay, who's the most motivated seller in 2023 and 2024? I would submit it wasn't people with existing buildings. It was builders who were building new product
Oh,
who
wow.
maybe got it out of the ground anticipating 4% rates,
Right,
but by
right.
the time they got it built, it was 6. So we went in and bought small, typically duplex communities that builders had built with the expectation to sell retail, and we bought them in bulk. Basically, we told them, hey, you build them, we'll close them 15 days after
Wow.
CO. So we, in 2023, 2024, we primarily bought new product and run it as build to rent. Uh, our last two acquisitions have been a 1970s heavy value add and a 1980s kind of light value add, property tax abatement, affordable property. So I think as investors, you have to adjust as the market dictates. Now, I'm also a believer that to the degree you can drill deep and find a niche as an investor, you're going to do better than if you spread yourself too thin. So, when the multifamily market dried up, we found the same operators starting to do car wash syndications or ATM syndications or hotel conversions. And to me, that's crazy because I think if you're raising capital from other people, you're raising capital with the notion that, hey, I'm an expert in this type of asset. Your capital is safe with me. So, for example, you could have a great operator in Dallas Fort Worth that does Class A new build luxury downtown apartments.
Right.
And they can
Okay.
be fabulous at that.
Right.
That doesn't mean they're good in 1970s workforce Class C in Charlotte, right? So I'm kind of a big horse racing fan, and there's an expression, horses for courses, meaning certain horses like certain tracks. So I think as an investor, you want to look for operators that have a narrowly defined niche and some proven track record of success in that niche. Because once you kind of find your niche, it's kind of rinse and repeat. Senior living facilities are big right now, and I understand the demographic imperative behind it, all as baby boomers are getting old and we're the biggest cohort in American society. But running a senior living facility is much different than running an apartment building, right? And so I'm going to stick to what I know. I'm going to stick to the market I know.
Well, okay, let's back up for just one second.
Okay.
I want to know a little bit more about the 1980s affordable unit. I mean, I know what affordable is out here in the Bay Area and, Section 8 buildings and yada, yada, yada. But
Yeah.
what's that mean in North Carolina?
Yeah. So in my area, Greenville, this 96 units, mid 1980s product, 96 doors. Typically a 2-bedroom, 1-bath unit, maybe 800 square feet. The rent's about $1,000 a month. We paid about $115 a door. Median household income in Greenville County is about $80,000, which is pretty healthy. In my market, I would say when the rent's below $1,000, you're typically looking at residents who are on some kind of public assistance program.
Right.
Between 1,000 and 1,500, you're kind of looking at hardworking people who are gainfully employed, but they're maybe making 50, 60, 70,000 a year. And then it can go up. We like to kind of be in that bread and butter range of 13 to 1,500. So your old rule of thumb, monthly income should be 3 times the rent. If you're at 1,500, your resident should be making 4,500. Let's call it 5,000 a month. That's 60,000 a year, which is, there's a large pool of people or couples who are making that. So we kind of like to stick with meat and steak and potatoes, bread and butter in that solid kind of lower middle income thing, because there's strong demand there and they can pay rent, they care about their credit, and so we find it's really a good spot to be in, where residents who are at a lower income level, the truth is, if they have a $500 car repair, they can't pay the rent that month, and it's nothing about their character, integrity, or their worth as a human being. I think most of us know, within our American economy, especially the last couple years, the higher up you are on the income level, you're doing better, where relatively the people at the lower end are struggling a little bit more, and inflation's kind of exacerbated that problem. So we just like to kind of keep it in that range. We generally maintain 95% occupancy. Credit loss is usually about 1.5%, with for residential is a pretty good number. So that's kind of what we do.
So it sounds like you're not evicting very many tenants.
No. And, investors always talk about landlord-friendly states. It's really more a county issue, because the county courts thing. And so Greenville's relatively conservative. The Charleston area of South Carolina, which is the other great market, they tend to be a little more liberal. So the eviction issue is handled a little bit differently. My partner, Brian, who runs the operations, he has a policy and procedure manual, and he follows it with every resident. And basically, if the rent isn't paid by the 10th, we give a tenant notice on the 11th to start the eviction process. The truth is, 90% of the tenants bring the rent current before the end of the month. And it's a process out here that Brian's property management staff handles the evictions if they go to court. And so it's not like in the Bay Area, where as a landlord, you better bring an attorney to the court to properly represent you. So we don't have many evictions. Also, part of that is proper due diligence on the applications. And we tend to do smaller properties. We actually like the sub 100 unit properties. And so Brian's staff actually gets on the phone and verifies all the information on the application. Where I would say many of the bigger operations, they don't have the time to do that. They can't do that for 1,000 units. So they rely more on some automated system. Right. And I think it can cause difficulty because, somebody could have a credit score of 575.
Okay.
Right, which, normally people, it's not great, but somebody, normally people kind of like 600, 620 is kind of a baseline. But the point being is somebody could have 575, but unless you really understand what caused the 575, you can't really properly evaluate that potential residence, right? If it's 10 credit cards with consumer debt that have caused the problem, that's one thing. It's another thing if somebody got laid off for 3 months and now they're employed again. so you kind of got to dig in, and then verifying the information over the phone with past landlords and employers helps. So Brian does a great job with tenant screening, so we do fairly well with limited need to evict.
So how long does an eviction take out there?
Basically, if it's non-payment of rent, you could figure 30 days.
Wow.
Yes. Yes.
Boy, that would be nice. Out
Yes.
here, we're lucky to get it done in 6 months. So
Yeah. So it's a little bit different. I'm only 120 miles from Atlanta. And at one point in Fulton County in Atlanta, evictions were taking a year. Because different jurisdictions reacted to COVID differently. Many had moratoriums, and then you had a backup, and it took some while. But yes, as a property owner, you want to be able to kind of process these things in a reasonable thing. And the other thing I would say is, if you have kind of policies and procedures where every resident is treated exactly the same, that's the way to conduct business. It's just, here are the rules. And what I would say is, when we buy buildings, oftentimes we buy them from long time, let's call them mom and pop operators.
Okay, right.
And they tend to be a little lax, so,
right.
They paid $20K a door for the building 25 years ago. They're getting $700 rent, it's like, whatever. So they don't mind if the tenant pays the rent on the 12th. It's no big deal. So what we find is, when we take over a building, part of our task is to kind of educate the residents as to what our expectations are. And that may take a month or two. But again, when there's communication with the residents, and there's clear guidelines, I would say 95% of them get on board. They may have gotten a little lazy because the landlord was lazy and didn't care.
Right.
So it just takes a little time to kind of get things running properly. And we usually think it usually takes us about a year to kind of go through a building and get things operating at the level we want.
So that brings me up to the question of, what property management software do you use?
My partner Brian uses Buildium.
Yeah. Okay.
And so that's an interesting story. So was a residential property manager. He has 11 employees, maybe manages about 500 homes in Greenville County.
Okay.
And I always self-managed all my rentals in where I live. So when I had them in the Bay Area, I managed them. The ones in Greenville, I managed them. Of course, we all think we're the greatest property manager, but that was crazy. I was okay, but I really wasn't that good. But it was okay. So I started turning over my rentals to Brian, and we developed a relationship. And then I decided, after 35 years as single family, I wanted to move to multifamily. And this all happened right about the time COVID hit.
Oh, wow.
So I knew I wasn't the greatest operator. And what we're finding in this market is operations are really key. When the market's going crazy, you can mismanage a building and still make money. When you're in a normal market, a flat market, a slightly declining market, you really know how to operate. You better know how to operate these buildings, or you're going to lose your shirt. And I knew I wasn't the operator. I'm great at hunting deals. I'm great at talking to investors. but I didn't take the plunge to buy the first multifamily until I got Brian on board. And it took me about a year, and we joke I was courting him for a year to come on board. And we looked at 5 or 6, and then eventually we found one we both liked, May of 2021, and we bought it. And since then we've been off to the races. But I didn't want to take that leap and ask for other people's capital until I knew I had a guy who really could run these things, and he's done a great job. So he's been a great partner. My other partner, Dan, kind of came from a Silicon Valley startup. He was CFO, COO. He loves spreadsheets. And after building a relationship with him for 2-3 years, he quit his CFO career, and he's now kind of gone into real estate full time. So
Wow.
he handles the underwriting, the modeling, the accounting, the tax reporting.
Oh, wow.
Brian handles the operations, and then that just frees me up to go do what I do, which is just hunt deals and talk to people and turn over stones. And so you need kind of different skill sets when you get into larger commercial deals, and it's rare that one person has all those skills. And the other thing I found in life, generally you're best at the stuff you like doing, right?
Right.
If you don't like doing something, you're probably not very good at it. So teaming up with some people makes it easier to maximize your skills and put on somebody else's plate the stuff that you don't want, but that rocks their boat. So we found a good team, and we've got a good mix. And so that's kind of been fun, where single family investing, I find, is more a solitary existence, right? And nothing wrong with single family investing. You'll hear multifamily people maybe talk down about single family, but I would just say, as an individual, if you could pick up a single family rental every 1 or 2 years, and you do that for 10 years, trust me, at the end of 10 years, you're going to be happy. You're going to have some nice income. You're going to increase your net worth. And so I think it's not so much what's the best way to invest, but I think it's more what way of investing works best in the totality of your life. What do you enjoy doing? How's your life structured? How much time do you have to devote to it? I believe there's a reason for specialization of labor, right? I have a gardener. We're redoing the front porch. I hired somebody to do it. Yes, I could do it, but would I do it as well? Probably not.
No.
Would it be a pain in the ass and take me hours and hours? Yes. So there's a reason for specialization of labor, and it's the same thing with investing.
So that brings us to, what do you see in the future?
Yeah, it's a great question. And of course, I don't know, but I'll share my 50 years of experience in real estate. And number one, I'm bullish on real estate. I'm bullish on America. Not to say we're perfect, but I think we are still the world's economic engine. And for all the talk of China, I don't think that's changing. The brightest, most ambitious people from all over the world come here to make a difference. So I'm bullish on America. I'm bullish on real estate. What I've generally seen in my career, real estate tends to go in 10-year cycles. And my experience is you get 6-7 years of a pretty strong bull market. Then you might have a year or two of some retrenchment, a little bit of decline, and then maybe you get a year or two of flat.
Yeah.
And as all that does is set the stage for the next run up.
Yeah.
So the key for real estate investing is one, have a long term perspective. Two, set it up in a way that you can survive the inevitable rainy days. Because if you can survive the rainy days, I promise you're going to win. And the way we do it, fixed rate debt, low leverage, have ample cash reserves, and know how to operate the properties you own, or hire somebody who knows how to operate them. If you do those four things and you have a long-term perspective, you're almost invariably going to win. And what that means is you don't have to be the smartest guy in the room or the smartest gal in the room. You don't have to time the market. You just have to be prudent, steady, and consistent. So, what do I see in the next short term? I think we're right now kind of in the plateau period. In multifamily, we went up. Office went up. Office is struggling a little bit, but I think we're kind of reaching a plateau. And my sense is interest rates will come down, might not be for another 6 to 12 months. And of course, politics is mixed into it all. But I would say when rates drop a little bit, you're going to see kind of a huge flurry of activity. There's people who want to buy, they can't get together on price, and part of that's debt. There'll be a flurry of activity. I think the economy will get a real nice jump, and I think that will set us off on another 5, 6, 7 year bull run. We're maybe about a year from that, but that's kind of my sense as to what I see happening, and that's how I'm investing. And again, when I buy something, I don't even really care what it does today, other than it has to be self-supporting. It has to support itself.
Right.
It needs to cash flow, but the cash flow isn't to create spendable capital today.
Right.
The cash flow is to protect against Murphy's Law or some downturn, so that the property always pays for itself, right? Because if the property pays for itself, you never are forced to sell, and you just ride out the bad times. So that's kind of what I expect. I think, COVID was horrible in a lot of ways, and I'll be interesting to see how historians write about it if I'm around 20 years from now. But I think it's pretty clear we do need to pay more attention to kind of bringing manufacturing back home. I think we also need to provide good jobs. One of my favorite expressions is not everybody's meant to be a Facebook or Googler. Right. And so we need to find a way to provide jobs. And my sense is it's kind of going to be high-tech manufacturing. It's going to be manufacturing, but there's going to be tech involved, and that will supply income and help build back our middle income segment, which I think is critical. So I think that AI, so I think there's kind of a lot to like. So if we can bring some of this back, both from an economic point of view and a national security point of view, I'm optimistic about that. And I think most people kind of understand the need to do that. So I'm kind of optimistic about the future, and but again, it's a long-term game, and who knows what's really going to happen. But overall, I'm optimistic.
Okay, well, let's end with a quick question about what food you like.
Well, I really love pizza or charcuterie, but now that I'm older, my life partner, Laura, regulates that on me a little bit. So, I get it in small bites, but I really enjoy it when I do. Plus, I'm Italian, so I could live on bread, cheese, and salami. All right.
And who in the world, alive or maybe not so alive, would you like to sit and eat your pizza with?
I would say Albert Einstein. And not only was he a brilliant scientist, but if you read some of his talks and expressions, he really was kind of a brilliant man about life. So a lot of his commentary went above and beyond science. And the other personal part is the house we live in, Greenville, was built 1938. Albert's son, Hans Einstein, was the first resident of this house.
Oh, wow.
And we have this documented because Hans had a son who died at the age of 6, which was common back in 1920, 38, and so forth, right?
Yeah,
and the death certificate shows this address as their residence. So, and Albert was known to visit Greenville quite regularly, and I'm sure he spent time in the house. So, the other connection is my degrees in physical chemistry. It was quantum mechanics, which was basically what Albert did. So a giant of a human being, and it would be great to sit down and have pizza and a glass of wine with him. And I bet he would have quite a few glasses of wine.
All right. Well, let's end with that. I want to come back in 6, 8, 12 months or whatever and reconvene this conversation. And
that would be great. Love this. Yeah.
Interest rates are coming down. That would be very fun.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.